Traditional earnings metrics suggest this energy giant is 22% overvalued. Yet a deep cash flow analysis claims it is trading at a staggering 54% discount. But is this massive gap the opportunity of a lifetime or a value trap set by a dying industry? The Benjamin Graham Formula values this stock at just $115 per share, while a discounted cash flow model places the true value at $311. Most aspiring investors stop at the price tag. They see the stock hovering around $141 and feel paralyzed. It sits in a no man's land. Too expensive for the conservative formulas, but cheap compared to the optimistic forecasts. And this is exactly where the anxiety of investing comes from. You look at a generic buy rating on a financial news site, but it feels like a black box. They don't tell you why. You feel like a gambler placing a blind bet. To eliminate that feeling of helplessness, we have to dismantle that black box. We need to look at the gears turning inside, starting with a metric that seems to defy logic. Despite a 12.3% drop in net income and earnings per share falling from $7.55 to $6.99, EXXON Mobil's price to earnings has actually surged. It jumped from 13.5 to 16.5. For those new to stock market analysis, the PE ratio is simply how much you are paying for every dollar of profit the company makes. At first glance, this looks incredibly dangerous. If a company is making less money, the stock should be cheaper, right? That is the intuitive logic. But when we look deeper, the picture gets complex. This is what we call multiple expansion. Think of it like buying a rental property. The rent checks are getting smaller, yet buyers are offering more money for the house. Why? Because the market is forward-looking. This divergence tells us that Wall Street is aggressively pricing in future optimism. They are betting that today's profit dip is just a temporary blip, not a permanent decline. And the lesson for us here is simple. Price action often leads fundamentals. When the multiple expands while earnings contract, smart money is betting on a turnaround. Understanding this replaces skepticism with control. You aren't just looking at a high price, you are looking at market sentiment quantified. However, sentiment can be wrong. And this leads us directly to a flashing red light in the operational data. While revenue dropped by 5.2%, the inventory levels on EXXON's balance sheet swelled by 14.1% to over $27 billion. Ask yourself, is a warehouse full of product a sign of strength or a bottleneck? On the surface, having more assets sounds good. More oil, more product, that's value, right? But compare that to the falling revenue. This disconnect suggests EXXON is producing fuel and chemicals faster than the market can swallow them. This is a glut. When you have $27 billion of inventory sitting stagnant, you aren't just losing sales, you are paying to store it. This challenges the narrative that EXXON is running an ultra-efficient ship. It forces us to ask if demand is softening faster than management admits. The golden rule for your investing strategy is this: always watch the divergence between sales and inventory. If sales go down and inventory goes up, cash flow is about to get squeezed. And speaking of cash flow, this leads us to an even bigger problem. If the inventory isn't moving, what is happening to the company's wallet? The company's quick ratio has fallen below the safety threshold of 0.8. For context, the quick ratio is the wallet test. It asks if the business stopped today, could it pay its immediate bills without selling any inventory? Right now, for EXXON, the answer is barely. Even more concerning, the net cash flow plummeted by nearly 900%, actually turning negative. Now, let's be clear, with an Altman Z-score well into the safe zone, EXXON Mobil is nowhere near bankruptcy. They aren't going to disappear. However, this sudden evaporation of liquid cash restricts their agility. It's like a heavyweight boxer who suddenly loses his footwork. He can still punch hard, but he can't move fast. When liquidity tightens, a company has less freedom to maneuver during market shocks. This is the kind of insight that separates real fundamental analysis from guessing. When you see a strong buy recommendation on a competitor's platform, they rarely mention that liquidity is tightening. They leave you exposed. By tracking this yourself, you gain the peace of mind that comes with knowing the risks. But if the cash is tight and inventory is stuck, why hasn't the stock price collapsed? To understand that, we need to look at a secret correlation that most retail investors miss. We ran a statistical analysis on what actually moves Exxon's stock price. We found an exceptionally strong correlation of 0.81 between Exxon's total assets and its stock price. This is far stronger than the correlation with its operating income. This is a massive revelation. It implies that Wall Street views EXXON Mobil as an asset play. They are valuing its reserves, its pipelines, and its too-big-to-fail infrastructure more than its quarter-to-quarter profit. Think about the psychological shift this causes. If you are analyzing Exxon based on whether they beat earnings by a penny, you are playing the wrong game. The market treats this stock almost like a bond or a piece of real estate. They are buying the size, not just the growth. But an asset-heavy strategy only works if the foundation is solid, and this is where we find the company's hidden safety cushion. Amidst falling revenue, the company executed a disciplined 11.1% reduction in long-term debt. This brought their debt-to-equity ratio down to a pristine 12.2%. This is the paradox of a well-managed giant. While their sales team struggled, their financial engineers fortified the castle. By reducing debt, they lowered their break-even point. This protects the dividend, which is the holy grail for Exxon shareholders, and prevents the bearish case from taking over. The lesson here is vital for value investing. In cyclical industries like energy, solvency matters more than growth during a downturn. Management is prioritizing balance sheet health over expansion. They are hunkering down. But we cannot ignore the elephant in the room. We've discussed the safety, the inventory, and the debt. But what about that $311 valuation from our discounted cash flow model? That number suggests the stock could more than double. Where does that massive number come from? It comes from something called the terminal value. In financial modeling, terminal value is the forever assumption. Our model assumes that Exxon can keep generating cash, growing at just 1% forever. That future stream of cash is worth $1.6 trillion in today's money. And here lies the ultimate narrative conflict. For that $311 price tag to be real, you have to believe that fossil fuels will remain a dominant cash cow for decades. You have to bet against the narrative of a rapid green energy shift. If you believe the energy transition will be slow and messy, Exxon is trading at a 54% discount. It is a coiled spring. But if you believe regulation and renewables will crush demand in the next 10 years, that terminal value evaporates. You are left with the Graham number of $115. Meaning the stock is overpriced. This brings us back to our core thesis. EXXON Mobil is a valuation paradox. Operationally, the engine is stalling, evidenced by the inventory glut and tight liquidity. But structurally, it is housed inside an impenetrable fortress of a balance sheet. The market is paying a premium today for earnings that aren't there yet, banking on the sheer mass of the company's assets and the durability of oil. So, is it strong or weak? Currently, operationally, it is weak. Efficiency is dropping. But financially, it is incredibly strong. And that leads me to my prediction. I believe the gap between Exxon's stagnant growth and its massive cash potential is unsustainable. They have cleaned up their balance sheet for a reason. That is why I believe that within the next few years, Exxon Mobil will be forced to make the biggest acquisition in its history. They won't just drill for more oil. They will use that pristine debt capacity to buy their way into the future, likely targeting a massive player in carbon capture or renewable technology to secure that terminal value the market is so desperate to believe in. When you understand this, you aren't just looking at a chart, you are watching a strategic game unfold. And that is the power of true stock market analysis. But I want to hear your take. Do you think Exxon's forever value is real, or will the green transition make their assets worthless in a decade? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.